Is the greatest token alive a massive diamond in the rough waiting to deliver historic gains, or is it an engineered financial illusion designed to leave late-stage investors holding a completely worthless bag? Right now, the GTA token is trading at an incredibly minuscule price of approximately $0.00001648. However, it is flashing a massive eye-popping 57.72% gain over the last 24 hours. But do not let this sudden, explosive daily green candle blind you to the broader, harsh economic reality. If you zoom out even slightly to the multi-week or monthly timeframes, the overarching macro trend tells a completely different, brutal story. It is a chart heavily dominated by consistent lower highs, broken support levels, and technical sell signals that have triggered massive red alert lights across institutional trading dashboards. Yet, despite this bleeding macroscopic trend, a highly passionate community of microcap speculators and degenerate gamblers are aggressively pounding the table. They insist that at this specific fraction of a cent, this token is fundamentally and severely undervalued. They argue that the broader market is completely blind to the explosive narrative potential behind the project. Are these daily buyers brilliant, forward-thinking contrarians loading up at a generational bottom, or are they blindly sprinting into a classic, heavily manipulated value trap? Let's strip away the hype, jump straight into the raw data, and dismantle this setup piece by piece. To truly understand why the greatest token alive is suddenly experiencing massive trading volumes and blowing up across social media algorithms today, you have to look closely at what this asset actually purports to do. Unlike standard utility tokens or institutional corporate derivatives, GTA operates deep within the high-stakes, hyper-speculative world of culture, gaming lore, and community monetization platforms. The project is built on a highly ambitious decentralized framework aimed at gamifying token holder participation, launching micro dApps, and rewarding early Web3 adopters with ecosystem incentives. It is in sharp, aggressive focus right now because microcap meme assets and gaming altcoins are undergoing an absolute wave of violent capital rotation. Speculative money is rapidly moving out of large cap assets and flooding into ultra low price tokens, trying to chase the next elusive 100 times return. This influx of capital has created massive liquidity spikes and incredible daily percentage pumps. But the dark underlying issue holding the token back is a severe structural mismatch between short-term speculative hype and sustainable long-term tokenomics or actual utility adoption. Before we break open the technical chart setups, order book imbalances, and systemic vulnerabilities, I need you to do me a massive favor. Smash that like button, subscribe to the channel right now, and leave a compulsory comment below with your exact playbook. Are you holding your GTA bags, taking profits on this 57% pump, or cutting your losses completely? Leave a comment right now because your real-time engagement directly feeds the algorithm and keeps these deep dive asset breakdowns alive. Now, let's pull up the trading charts and jump straight into the technical analysis. Because while community sentiment can easily be faked, order books, volume profiles, and historical price action never lie. When you map out the daily and weekly timeframes, the greatest token alive has been locked inside a grinding, multi-month descending wedge pattern. Every single past attempt by retail buyers to break out of this heavy structure has been met with massive, violent institutional distribution at the 50-day moving average. This moving average is currently acting as a dynamic, impenetrable iron ceiling overhead. This explosive 57.72% daily pump has driven the price right up against a critical horizontal resistance zone near the $0.000018 level. If the immediate buying volume begins to taper off over the next few hourly sessions, this entire move will be classified as nothing more than a spectacular dead cat bounce designed to bait late buyers. Looking closely at the momentum oscillators, the Relative Strength Index, or RSI, has violently jerked upward from deep oversold territory into the mid-50s. This confirms an intense burst of short-term buying power, but the overall volume profile remains incredibly thin and highly illiquid. The immediate support floor is resting directly at the $0.000015 level. If that boundary snaps on a high-volume daily closing basis, there is a total vacuum of historical price data below it, which could could plunge the token into an accelerated price discovery phase to the downside. Short-term strength looks highly volatile and deceptive, while macro structural weakness remains firmly in the driver's seat. When we shift our focus over to professional analyst ratings and smart money flow signals, the broader outlook requires immense caution. On-chain tracking intelligence and algorithmic market dashboards currently label the GTA token with a firm, strong sell or heavy hold warning rating. The negative indicators are piling up rapidly behind the scenes, specifically regarding wallet concentration and whale accumulation metrics. Over the last 30 days, blockchain ledger analysis reveals that several early developer wallets and massive whale addresses have been steadily distributing their holdings directly into the retail market. They are using these sharp, short-term percentage pumps as exit liquidity to trim their exposure. When the largest shareholders of a microcap asset are quietly offloading their tokens during green days, it creates an incredibly heavy systemic overhead supply wall that makes a sustained macro recovery nearly impossible. Furthermore, institutional market sentiment metrics emphasize that the token's trading volume is highly fragmented across decentralized exchanges with shallow liquidity pools. This environment naturally amplifies the risk of sudden, erratic, and coordinate price manipulation. The short-term outlook strongly indicates that unless a massive, unprecedented fundamental development drops out of nowhere, the path of least resistance for the GTA token remains tilted downward. This objective reality brings us directly to the ultimate, highly polarized debate. Is the greatest token alive truly an undervalued asset trading at a lifetime discount? Or is it a dangerous, beautifully marketed value trap designed to wipe out retail portfolios? The bullish community argues that at a price with 4 zeros, the downside is mathematically negligible, while the upside potential is practically infinite if the project captures mainstream viral attention. They view this sub-penny range as a prime, high-yield accumulation zone where small amounts of capital can turn into fortune. The bear camp, however, views this logic as a complete mathematical delusion. A value trap occurs when an asset looks incredibly cheap simply because its structural token mechanics, utility, and network demand are actively decaying. If a project cannot foster consistent organic transactional utility that forces users to actively buy and lock up the token rather than treating it purely as a short-term pump and dump asset, the price will naturally and inevitably bleed to zero over time. A low nominal price does not mean you are buying a bargain. It can simply mean you are buying an asset on a slow, painful march toward total illiquidity. The downside risks embedded in ultra-low price microcap assets like GTA are absolutely immense, and undisciplined retail traders get brutally trapped in these exact market setups every single day. The primary reason retail investors suffer devastating, catastrophic losses in these ecosystems is a psychological bias toward nominal bias. Traders look at a token priced at $0.00001648 and falsely assume, if this token just goes to a penny, I will easily make thousands of times my money. What they completely fail to realize is that market cap, circulating supply inflation, and order book depth entirely dictate price movement, not blind hope. Low-priced tokens are notorious for extreme stomach-churning volatility because they possess incredibly shallow liquidity. When panic hits the broader crypto market, buyers disappear instantly from the order books. This creates a worst-case scenario known as catastrophic slippage, where your portfolio dashboard might show a certain dollar value, but when you actually click the sell button, the lack of market depth forces your order to execute at a massive, devastatingly lower price, locking in massive capital destruction. Let's clearly outline the absolute best case recovery scenario versus the worst case bear continuation. In the absolute best case bull scenario, the development team successfully delivers a major tier 1 centralized exchange listing, implements a massive token burn mechanism that incinerates half the circulating supply, and launches a viral marketing campaign. This massive shift in market fundamentals would force short sellers and speculators to rapidly buy back tokens, triggering a violent historic short squeeze that could easily blast the price past major psychological resistance levels. On the flip side, the worst-case continuation scenario is backed by far more historical chart data. If the immediate support floor at the $0.000015 level fails to hold during the next broader Bitcoin or altcoin market correction, automated stop losses will trigger simultaneously. The resulting panic selling cascade could easily wipe out 60% to 80% of the token's remaining value within a few hours, leaving late-stage retail buyers holding a completely illiquid, untradeable bag of digital dust. Looking at the comprehensive outlook, we are witnessing two entirely different timelines unfold at the exact same time. In the immediate short term perspective, the macro trend is undeniably pointing downward, and trying to fight that trend is historically a financial death sentence. Expect continued choppy price action, massive high frequency volatility, and deceptive fake outpumps as automated trading bots aggressively exploit retail emotions at these lower bounds. From a long term perspective, the survival of the greatest token alive relies entirely on its ability to transition away from a speculative trading vehicle and establish real, non speculative economic value. Without a radical overhaul in its token release schedule and an expansion of cross chain liquidity access, the long term chart will inevitably continue to mirror the short term macro decline. So, where does that leave us at the end of the day? Is the greatest token alive a ticking time bomb waiting to completely liquidate the remaining retail community? Or is this massive 57% daily surge the definitive historic bottom before a legendary multi-thousand% reversal that catches the entire crypto market completely off guard? The data is sitting at a brutal, unforgiving crossroads, and the next major breakout or breakdown is going to catch thousands of undisciplined traders completely unprepared. Which side of the order book will you be standing on when the real move begins?